Have you ever wondered how mortgages work in the USA? Well, a mortgage is essentially a loan, typically provided by a bank or mortgage lender, that assists individuals and families in purchasing real estate, such as a home or a property. Now, why is understanding mortgages important, you ask? Well, for most people, buying a house is one of the largest financial decisions they'll ever make. And it's not a simple one. There are numerous factors and details involved, which can be quite overwhelming. A mortgage can be a powerful tool, enabling homeownership and the ability to invest in real estate. But like any tool, it's essential to understand how to use it effectively. It's not just about borrowing money and paying it back. There are different types of mortgages, terms, rates, and many more elements that play a significant role in this process. Stay tuned as we delve into the nitty-gritty details of mortgages. The first key point to understand is the down payment. This is the upfront amount you pay towards your home purchase, and it's typically expressed as a percentage of the property's total price. It's like a show of good faith to your lender, indicating you're serious about this investment. Why is it necessary? Well, a down payment reduces the lender's risk. By having some skin in the game, you're less likely to default on the loan. It also affects the size of your mortgage. The more you put down, the less you need to borrow, and that can save you a bundle in interest over time. There's no one-size-fits-all answer to how much you should put down. It can vary depending on the type of loan, your financial situation, and other factors, but generally, a down payment of 20% is considered standard. Remember, the higher the down payment, the lower the mortgage. Scene script. Next up, we have the interest rate. When you hear about interest rates, think of it as the cost you pay for borrowing money, in this case the mortgage loan. It's a percentage of the loan that lenders charge annually for the privilege of borrowing their money. How are these rates determined? Well, they're influenced by a variety of factors, including market conditions, your credit score, and the type of loan you choose. So, why should you care about the interest rate? The reason is simple. The interest rate directly affects the total cost of your mortgage. A higher interest rate means a higher monthly payment and a higher total cost over the life of the loan. On the other hand, a lower interest rate can save you a considerable amount of money over the life of your loan. That's why it's always important to shop around for the best rate. So, a lower interest rate equals lower monthly payments. Now let's talk about loan types. In the realm of mortgages, there are several types of loans that you can choose from, each with its own unique features. First up, we have conventional loans. These are typically offered by private lenders, and they're not insured by the government. They usually come with stricter eligibility requirements, but can offer more flexibility in terms of loan amount and terms. Next, we have FHA loans, or Federal Housing Administration loans. These are insured by the government and are designed to help low to moderate income borrowers. They require a smaller down payment and are generally easier to qualify for than conventional loans. Lastly, we have VA loans, which are backed by the Department of Veterans Affairs. These loans are exclusively for veterans, active duty military personnel, and their families. They offer benefits like no down payment and competitive interest rates. Choosing the right loan type can make a big difference in your mortgage. Ever heard of the term amortization? Well, strap in because we're about to dive into it. Amortization, in the simplest terms, is the process of paying off your debt in regular installments over a fixed period of time. In the context of a mortgage, it's how each payment is split between paying off interest and reducing the principal balance. Initially, a large portion of your monthly payment goes towards the interest, and a smaller part chips away at the principal. As time goes on, this ratio shifts. More of your payment is applied to the principal, meaning you're building equity in your home faster. Visualize it as a scales of balance. On one side you have the interest and on the other the principal. As time passes, the scales tip more towards the principal. Understanding amortization gives you a clearer picture of how each payment impacts your overall debt. So remember, amortization helps you understand how your debt decreases over time. Let's now turn our focus to loan term. When we talk about loan term, we're referring to the length of time you have to repay the loan. This time frame is laid out in the mortgage agreement and can vary quite a bit. In the United States, common loan terms are 15, 20, and 30 years, although other durations are possible. The loan term influences your monthly mortgage payment and the total interest you'll pay over the life of the loan. A longer term means lower monthly payments because the cost is spread out over more years. But here's the catch. It also means more interest paid over the life of the loan because you're borrowing the money for a longer period. On the other hand, A shorter term results in higher monthly payments, but you'll pay less in total interest over the life of the loan because you're borrowing the money for less time. Remember, a shorter loan term means less interest paid over time. Next, we come to closing costs. These are the fees and expenses you pay to finalize your mortgage, and they're typically paid at the time of closing your loan. Closing costs can include a range of charges. You might see things like origination fees, which are paid to the lender for processing your loan. Appraisal fees are another common charge, compensating the professional who assesses the value of the home you're buying. You might also see costs like title insurance, which protects against problems with the property's title, and escrow fees, which cover the cost of managing your escrow account. While these costs vary, they typically range from 2 to 5% of the loan amount. So for a $200,000 mortgage, you could pay between $4,000 and $10,000 in closing costs. These are not insignificant amounts, and they can significantly impact the overall cost of your mortgage. Always factor in closing costs when calculating your total mortgage cost. Now, let's discuss the role of your credit score. This 3-digit number is like a financial report card, reflecting your creditworthiness to lenders. It's calculated based on your credit history, including your payment punctuality, debt levels, and credit length. The higher your score, the more reliable you appear to lenders. So, how does this affect your mortgage approval? Well, your credit score can significantly influence both the approval and the terms of your mortgage. A high score could mean more favorable interest rates, while a lower score might lead to higher rates or even loan denial. But fear not, if your score isn't where you'd like it to be, there are ways to improve it. Paying your bills on time, reducing your overall debt, and not opening new credit accounts can help boost your score over time. Remember, knowledge is power, and understanding your credit score is key to navigating the mortgage process. A good credit score can help secure a better mortgage deal. Let's talk about private mortgage insurance and prepayments. Private mortgage insurance, or PMI, is a type of insurance that lenders may require when you take out a mortgage with a down payment of less than 20%. This insurance protects the lender if you default on your payments. It's important to note that PMI doesn't benefit you, the borrower, but rather it safeguards the lender's investment. Now, on to prepayments. Prepayments are additional payments you can make to accelerate the repayment of your mortgage. These payments go directly towards reducing the principal balance of your loan, not the interest. This may allow you to save significantly on interest over the life of the loan, and can even shorten your loan term. Prepayments are entirely optional, but they're a powerful tool if you're looking to save money and pay off your mortgage sooner. Remember, making prepayments can help reduce your mortgage balance faster. Lastly, we come to the topic of foreclosure, a term that strikes fear into the hearts of many homeowners. Foreclosure is the legal process by which a lender can repossess your home if you default on your mortgage payments. It's a situation no homeowner wants to find themselves in, but understanding it is crucial. So how does foreclosure work? If you fail to make your mortgage payments, your lender has the right to initiate foreclosure proceedings. This means they can take possession of your home, evict you, and then sell the property to recover their losses. But how can you avoid foreclosure? It begins with staying current on your mortgage payments. If you're struggling, reach out to your lender as soon as possible. They may be able to provide options like loan modifications, repayment plans, or even refinancing. Remember, staying informed and proactive can help you avoid foreclosure. Let's recap the crucial points we discussed today. We started off by understanding the concept of a mortgage in the USA, a loan provided by a financial institution to help individuals and families purchase real estate. We then dived into the significance of a down payment, the initial payment you make when buying a home. Next, we tackled interest rates, the cost of borrowing that the lender charges. We also discussed various loan types, each with its unique terms and conditions. We shed light on the concept of amortization, the process of paying off your loan over time. We also touched upon closing costs, the fees associated with finalizing your mortgage. We delved into the impact of credit scores on your loan approval and interest rates. We then unpacked private mortgage insurance and the option of prepayments, followed by the grim reality of foreclosure. Remember, understanding your mortgage can help you make better financial decisions. Thank you for tuning in.